Stock valuation. We hear a lot about stock valuation, how we can differentiate between the debt instrument and equity instrument. In the previous recording, we have a debt instrument and it was represented in the bonds. Now we are going to look for the equity instrument. So to identify the equity instrument, which is the stock, we need to determine both the features of common stock and preferred stock and making valuation for this common stock and know what the meaning of IPO and how we can estimate the IPO valuation techniques. So to differentiate between debt instrument and equity instrument, debt include all the borrowing, as we mentioned before, including bonds, and it is repaid according to fixed schedule that we named it before coupons. And these coupons, it is the opportunity cost that the issuer paid for the buyers in order to give him an incentive to buy. Coupon value. So this is what we call it fixed payment. While on the contrary, equity here consists of funds or multiple people or firm owners or investors, where they are going to invest in a company in order to benefit from the company performance. Firm performance will reflect on its profit. So the debt instrument and equity instrument, it is very well known in financing any economic activity. So debt is obtained from creditor and equity is financing obtained by investors. So when we look for the creditors, which is the lender, would they have the right to be repaid? Repaid of what? For their investment. So they are repaid in the forms of coupon value, and then they will receive the final principal at the end of the maturity. Another thing that we are going to differentiate between the debt and equity, the debt is limited in time. What do you mean by limited in time? This they have maturity date. While the equity is completely different, unlimited. Unlimited. If anyone tell me how long you will have this laptop till I am alive. So this is our difference between the limited and unlimited. And this is differentiate between them. So what make people look for these instruments? So when we go to differentiate between the debt and equity instrument, you will find that the people who have a debt instrument in the terms of bonds, as we explained in the previous video, so these bonds, it's a debt and it's obligation. So do they have voice in management? Do they have the right to say anything? No, they don't have. Do they have a claim on income of assets? Yes, because they are superior, they are first, they are provided first than the equity person. Do they have a stated maturity? Yes, they have at the determined date. Do they have tax treatment? Yes, we subtract and deduct interest from them. So this is the debt. They have limiting time and they have no voice in management. On the other side, we will see that the equity instrument, they have a voice in management in the board. Claims on income subordinate to the debt. So the debt first and then the equity. Do they have maturity date? No, they don't have a maturity date, which means that they don't have end line. So they are to infinity. Do they have tax deduction? No, they don't have. So the differences between the two of them is giving them each one an advantage and disadvantages. And this is what we call it the repayments of the bond, which is called a fixed payment schedule. And in the previous video, we know how we can make bond valuation. And today we are going to look for how we can make a stock valuation. So let's recap again. So unlike the creditor, holders of equity are owners of the firm. The stockholder usually have a voting in rights and them giving them the right in the firm directors and vote on special issues. In the contrast, in the opposite, the debt holders do not receive any voting privileges, but instead rely on the contract or the agreement, the time that they have. So the equity people, their claims, their assets on income cannot be paid until we pay all the debt first, because the equity holders have to receive their distribution first. So the common stock of a firm can be privately owned by private investors, owned by individual investors, or publicly owned. So it is open for everyone. In large corporations are publicly owned for everyone, anyone in the brokers or dealers market where they can help them to buy shares. And these shares, it is determined by what we call it par value. It is an arbitrary random value established for the legal purpose in order to determine the value of the shares and by dividing them to the book value of the common stock. When a firm sells its shares of common stock, the par value of the share sold is recorded. So if I have a car and its book value is 10 and in the markets its par value has become 50, so this is recorded in the valuations of these assets. And this is what we call it by value. We have also another two types of stocks, the preferred stocks and the common stocks. The preferred stocks gives its holder privileges. What are these privileges? They either give them a dividend percentage of the profit preset, or in terms of percentage of their dividends of the par value, or they can have amount, annual values, annual dollar values. So they are privileged. They have fixed periodic. And this is what we see it that we will name it later hybrid. What do you mean by hybrid? Hybrid, it have two characteristics. What do you mean by hybrid? That they have two characteristics. What are these two characteristics? They have fixed periodic payments. This is what we call, it is similar to the debt. And as well, this preferred stocks, it is lifetime to infinity. So infinity, they don't have due date for their expiry for the preferred stock. So this gives them an advantage. So this is the privilege of that we have in the preferred stock. So let's get a benefit from this. And when we look for valuation for preferred stock, so if I want to find the present value, then we are in need to determine the future value. But here we are not going to look for the future value. We need to look for the fixed depth that I have it, and then I'm going to discount it by 1 plus LR. But here I don't have a determined number of years. So I will divide it to perpetuity, then I divide it by R. And here we can make a valuation for the preferred stock value now by using this approach, by finding the depth, which is the fixed value, then divided it by the R, and this is what we call it valuation. But what happens if I have a changing dividends? And this is what we're going to see later in the common stock. So the preferred stock is fixed dividends, while the common stock, you will find they are depending on the profit that the company have. So here, how they issue the common stock, how they do that. So when we need to raise capital, we need to issue stocks. So we need to ask for an intermediate part, a neutral person to make valuation for my company. So how we go do that? We need to go public. And this are the steps for IPO, initial public offering. When a firm wishes to sell its stock in a primary market, it has three alternatives. Either a public offering, which offers its shares for sale to the general people, or a right offering, new shares are sold to existing shareholders, precise people, or the private placement in which the firm sell its new security directly to an investor. So if I am X company and I want to give it to investor Y company, so this is what we call a private placement. So we have three types: public offering for the public, no specific, or right offering, or private placement. So how we can do this IPO, initial public offering? So to do the initial public offering, an investment bank is required to be an disintermediate, a neutral body that is specialized in selling new security. So he will determine and look for the valuation of the company. And he will do something called underwriting. The role of the investment bank is in bearing and taking the risk of reselling at a profit and the securities purchased. So the process involves purchasing the securities issuing from the issuing corporation at agreed price. So we determine an agreed price and then bearing the risk of reselling once more. So the investment banks also provide the issuer advice. How much is the price? It is preferable to they be that or not. And for sure, he is taking an flotation cost or he is taking an commission cost. So going to the public, An underwriting syndicate, which is called the group of bankers, is an investment bank, to share the financial risk in underwriting the new security, in helping in issuing this new security. They syndicate shares the financial risk with buying the entire issue from the issuer and reselling to the new securities to the public. So they take care of reselling to the public. The selling group here is large number of brokerage, and later we differentiate between the brokerage and the intermediaries here. Joint originating investment bankers, each accept responsibility. So the investor is in the brokerage and each one of them take the responsibility of selling a certain portion of this new securities. Why? Because they are talking a commission base. So economic-wide, the rational buyers and sellers use the assessment of an asset risk and return to determine the value. In the competitive market, when they have efficient market, we can take a complete information, then the general concept of market efficiency exists, and there is an accurate calculations or valuation for the shares. So how we can determine the value of shares? Let's go for the types of stocks. We determine the preferred stock and we name it. This is hybrid. Hybrid, why? Because it's formed the bonds in some respect and two common stock in other aspects. Preferred stock as a par value and a fixed amount of dividends. So I'm taking fixed dividends. So it is like the bonds as we see. So however, a failure to make this payment, I will not bankrupt. So it is completely different here because if I fail to pay the debt, I will be completing bankrupt and this will put me in a bad credit rating. So the holders of preferred stock does not have the voting right like the holders of the common stock. So let's see what if I have a stock of a preferred $10 par value and I have a dividends 10%. So the value of dividends is 10% out of this $10. So I have this 10% of this $10, then I will have here the $1 as you see here. But what about the required rate of return in the market? It is 11%. So what will be the value of this preferred stock right now? If it is having a future value of $1, or if it is dividends, or I have a preferred stock of $10 par value. So here it will be 9.09. So this is what we call it, the present value of what? Of the preferred stocks. Perfect. So we did the first valuation, which is the easiest one. And let's go for the second one, which is what we call it, the common stock. So in the common stock, the valuation is completely different because the future cash flow or the dividend that we're going to have, maybe it's different according to each year. So DEV1 and DEV2 to infinity, the values of these dividends is going to be changed. So how we can find the value of each common stock? So since I have zero gross model, it is the simplest assumption. It is the easiest assumption. So hey, here I need to find first the D1. What is this D1, which is the future value of these dividends if that gross is zero? So I assume that this company growth is equal 0. So if this gross is 0 and I need to determine the new dividends, let's say I need to find the DEV for 2021. So I need to find the DEV for 2020 and I will take into consideration the rate here of the future dividends or the value of the new dividends, what will be the rate of the new dividends. Then I have to find the due dividends. And all over, I think that there is no change, then I need to discount it with respect to the required rate. So let's see how we can do this if I have the easiest one, which is zero gross model, which is constant growth for infinity. So it will be similar to the perpetuity. So if the dividends is the 3, the coming one is 3, and the R is of the required rate is 15, then the value will be 20. So what I did, I found the future value, the dividends in the coming year, and then I discounted with respect to the required rate. Perfect. So what happens if this model is growing? The growth rate is changing. 1 year is 2%, 3%, 4%. And here we use something called Jordan model. This is the brilliant model where we are going to assume that for a while I will have a constant growth. Maybe the government interfere and set the growth rate constant for a while to create stability. So the dividends will grow with a constant, but on reality, we don't have this constant growth. But for simplicity, for explanation, we will make the assumption that this growth rate is constant. So here I need to find the new dividends for the coming year, what is the required rate and the growth rate. So let's see here. If I have here a given dividends and I don't know what is the gross, so I will use the time value model, and using the time value, which means I have a future value, which is a present value times 1 plus R that we use it in the time value. The future value in 2020, the dividends will be 1.4. And here I will going to look for the present value, which is the $1. Then it is easily to find 1 plus LR. So if I find the 1 plus LR, which will end up by, I think it will be 15%. So this is, I will use it at the constant growth model. So let's see how we can solve such a things. So if I have this given information, I cannot predict. So I will use the formula that I said to you. So yes, it is 15%. And since this one, it is 1.4, how can I find 2013, let's say, for example? Or how can I find the new dividends? So how can I get 1.5? So if you are going to use the formula and you are going to use 1.4 times the growth rate, what will be the growth here? Okay, so let's see here, the annual growth rate, it will be 7%. So the D1 here, it will be 1.4 times what? Times 1 plus 7%. So if you're going to substitute, then it will give me $1.5. So this will be the new dev, and then I will use the model. So the value now of this share, it will be 18.74. So imagine that if you are offered now a stock to be sold by 19, and someone is telling you, I'm going to buy this stock with the 19, and the valuation of it is 18. So for sure, what you're going to do, you find the value is 18, and someone is going to offer you to buy it with 19. So is it get accepted or not? Sure, but I accept. Assume that you have a car and you make a valuation for it. It is 18.75, and someone offer you 19. So I will sure for accept. So this is the offer, and this is your task that you are going to make a valuation. But you here you're doing valuation for your own common stock. Perfect. Let's proceed. What's going to happen if I have the variable growth model? It's changing one nowadays. So the variable growth model, that means that the growth is not constant. So here the coming dividends is going to grow as we did in the 1.4 times 1 plus the growth rate. So here I need to find two things. I need to find the discounted value of all the dividends and the value of the common stock. So the first step is to find the dividends, new dividends. Second step is to find the present value of all the dividends. And the third step that you are going to find the value of the stock itself. And then you are going to add both of them. So simply again, so the first step that you need to find the future value of the dividends, which is D1 plus LJ. And then you are going to look for the sum of all these dividends at present. And then you're going to find the sum of the debts. Imagine that you have a car, and this car, let's say, for example, for simplicity, it is the car, the assets that you have. And the assets here is the stock. And then I need to find the present value of these assets. Perfect. Present value. As well, I need to find all the cash flow present value. And here I need to find the sum of all cash flow present value. And then I'm going to add both of them. And finally, I can say how much it will be. So this is the 4 steps for finding the values. So, but pay attention that I'm going to use the assumption of constant gross margin. So let's start by simple example and see what we're going to do in solving. So I have a company here, APC company, and it is expecting here to have a dividends $2. This is the coming year. And this $2 is going to grow by, let's see how much the growth rate. You will find that the growth rate here, it will grow by 10%. So I will add the 10%, which means that the dividends here, these dividends, D1, how can I find it? These dividends is easily to be found. How? Because I'm going to find the new dividends, which is all the dividends times 1 plus what? 10%. Perfect. So I find the new dividends, and I will repeat this in the coming year, and then I take 2.2 with the power 1, and then I find the 2.42. So here what will be, it will be 2.2, and then I multiply it 1 plus 10%, and here we will find the dividend. So this is the first step for the dividends. So the first step, number 1, we find the value of the dividends. Step 1, perfect, which is very easy, as I mentioned. Then what I'm going to do, I need to find the present value of the stock. But here, the present value of the stock is giving me that after 3 years, this is the future value, this is the FV. So the 40 is the FV. So I have here all the inflows of money, it will be 2.4, and the future value is 40. So I have here a future value in the 3rd year by how much? It is called, let's say, for example, 42. And in the 2nd year, I have a value in the future. I'm expecting it will be 2.2 only because I will sell the stock by the end of the 3rd year. And now the value of the stock is going to give me in the future value of the 1st year, $2. What I'm going to do, I said that we need to find the sum of all the dividends, but I will do a very smart thing, that I will discount all of them. I will discount the dividends with the market rate, required rate of return, which is 14. And then I record the 2nd one with the power 2 years, and then the 3rd with the 3 years. Perfect. And here, if you look for the discounting, you will find that the price of the stock is equal 32. If someone is offering you to buy the stock now for $30, do you think you're going to accept it? No, because he is offering you price less than the value of the stock itself. So this is the meaning of valuation for the common stocks in case of you're going to sell it after 3 years. Let's see another example in order to clarify a little bit more. If I have here that expecting to pay a dividends $2 next year while expecting to have it will be grow in what? After 2 years. So in this year, in the 1st, and this is the 2nd. But in the 3rd year, after 2 years, it's going to grow by 4%. So just I change the calculation. So 2.42 times 1 plus 4. So this is the only difference? Yes, it is the only difference. So if we're going to use the calculation, so we use 2.2, 2.42, similar to the previous one, but in this year, it will be 2.42 times what? Times 1 plus what? The new growth rate. What is the new growth rate? Is going to grow instead of 10, it becomes going to grow by 4%. Brilliant, very nice. So I determined the gross model. So this is the dividends. And I need to find the value right now of this stock. He didn't tell me. How can I find it? So to find the value of this stock, if I have a constant growth model, it will be very easy. Why? Because I know I will write it up alone. How can I got the 25? So I will start by looking for the new dividends. What will be the new dividends? 2.52. Very nice, 2.52. This is the DEV, which is using constant growth model. And then I'm going to divide it by the R. What is the R? It is the 14% minus the growth rate, which is 4%. When I do that, I will find that the common stock will be $25.2. And then I'm going to discount. So I discount the 2 plus 2.2, then 25 plus the 2.42. Then I discount all the values, and then we have the common stock values. So if we do calculation like that, we can determine how we can find the value of the common stock in the coming slide. So how we do this? As I said, 2.52 divided the difference R minus LG, 25, and then I discount them, and then I add the dividends in addition to the stock. Perfect. Let's go for the final stage. If I have a variable growth model and he's telling me that the both I have it is 1.5 and is giving me a share, both manufacturing, and the annual growth rate is 10%, the growth rate is 5%. So here I did it in a more details. I have 1.5, so I determined the growth rate. So this is the important point, that I determine all the dividends. This is all the dividends using the same formula. Dividends, 1 plus a growth rate at 10%, this is the dividends. And then here, I'm going to discount them. So this is the D1 for each year. And then here, it is the present value of dividends, perfect. And finally, what I'm going to do, I'm going to, this is the discounted, this is the present value of all dividend, present value of all that, and then I sum them, then it will give me 4.12. So how much it will be? It will be 4.12. How I did it? I did it in a simple way. I start by calculating the dividends, and then I discount the dividends, and 1.4, 1.32, and 1.37.32. This is the valuation. Pay attention, if I want to find the new, the value of the price, I have to take in consideration these $2, and I look for the change of the gross model. So in the previous slide, in the problem, he must give you two different values of a stock of growth rate. So the foreseeable growth rate, it will be 5%. It was 10 and then it changed to 5. It was 10 and changed to 5. So here, if I want to find the growth rate using the new growth rate, which is the 4.12. So if I want to find the price, then it is the $2 divided by R minus LG. I think the R it is 15 and the new G it is 5, and then I can find by this way the value of the stock. So let's explain it in the coming slide to see how it look like and how we can find it. So so it is the dividends, the $2. In addition to the growth rate, it's 2.10, and then the 2.10 divided by R minus LG. So this is the value of the stock. Finally, I'm going to discount the values of the stock to the time zero. So here we have 4 observations. We return to the year where we change the growth rate. So it's a 13.87. And then I discount them. And as you see here, you going to add the 4.14, the sum of all the stocks, plus the value of the stock itself, then is giving me the price of the stock at time zero. So this is simply how we can make valuation on common stock. Finally, we will have a free cash flow, and this free cash flow, we're going to explain it in the second video. So we know how we can find the stock valuation, but in the coming slides, the coming video, we'll see how you can find the free cash flow. Thank you.